We serve a customer base we call the middle majority. They are, if you think about credit, which we are a credit-centric bank, if you've got a lot of money, you don't need a lot of access to credit. You pay cash for a car, you save up to send your kids to college. If you're on the other end of the spectrum, you can't really access credit. So there's this middle group that are high income, heavy users of credit. So they can afford a car, they can afford to send their kids to school, but they need to use credit to do it. That's who we serve. It's a really big customer base. It represents about a third of the US population, but it's close to half of the credit wallet. So they are more likely than average to have every form of credit. And that credit is, with the exception of mortgages, also larger than average. That's who we serve.
How much do these people usually make?
Our average, and obviously misleading, averages can be misleading, but average is about $125,000. But you can think of it of ranging between, call it $80,000 in individual income to about $200,000 is where we really over-index.
Great. One of the real highlights of your recent Investor Day last month was the panel discussion with marketplace investors, and we talked about this earlier before your appearance here on radio. One of the panelists talked about aligning performance expectations, partnering with better operators. Are you seeing that with the private credit space?
Yeah, we do. So, we were born as a marketplace. Initially, everything we originated, we sold. When we acquired the bank in 21, we started to hold a portion of our loans on our balance sheet. That both gives us a stronger and more resilient earnings profile, also allows us to do other things, innovate using our balance sheet. And what we found is just by aligning our interest with our loan buyers, we're the largest eater of our own cooking. We're the largest holder of LendingClub loans. We care very deeply about the performance of the credit. And, credit is always evolving. It's very dynamic. Because we have a balance sheet, what we can do is when we want to test something new, we test it on our balance sheet. Let's try longer duration. Let's try a larger loan size. Let's try a new marketing channel. We hold that first.
You own it.
We own it. We make sure it performs the way we expect, and then we release that to the marketplace. If you don't have a balance sheet, you can't really do that. And so that's visible in our results across every aspect of underwriting. So lower delinquencies than the rest of the industry, 30 or 40% below, lower roll rates, higher recovery rates, lower prepayments, lower fraud. Literally every aspect that you can measure of credit, we're outperforming on.
Has that remained consistent this year, in recent months, in recent weeks? Like, you have a great real-time view of the consumer in the form of how well they are doing in terms of paying back their loans.
That's right.
Still looking good?
Yeah, so that's been consistent for, we release 4 years of data we put out there, and so it's remained consistent, but, it's kind of like a duck on a pond. It's remained consistent because we're doing a lot of work underneath the cover. So, something that we shared at Investor Day is at any given time, we have more than 200 tests in the market where we're evaluating price points, changes to the credit. So we're constantly adjusting to reflect what's happening with the consumer. And that's what's giving us the consistent results.
Well, so that to me says you're very picky about who you lend to.
That's true. We are.
So in terms of your test, so tell me what it is. I mean, and how many of people who apply or want to access your platform, you're like, I'm out.
Yeah, so we're pretty good at selecting who we want to have in our portfolio and reaching out to those people.
Yeah.
And then both delivering the price and product experience, but also, let's call it the user experience that gets them all the way through. So we look for areas where, for example, we can control the use of the fund proceeds. If you come to me and say, I want $20,000 because I'm going to do whatever, my kid needs braces or I'm moving cross country, great. But unless I'm paying the orthodontist, I don't actually know that that's what you're using it for.
Yeah.
So we try to, set ourselves up so that we are in some ways controlling the use of proceeds and then making the experience such that it makes it really easy. So our largest use case is for people who already have debt, credit card debt, most notably, which at this point, more than half of all Americans are carrying. They're carrying it at really high rates, 23% interest rate. It's highest they've ever been in history. And we say, great, you should do this instead. It takes less than 5 minutes. We're going to save you 700 basis points. Oh, and by the way, check all the credit cards that you have that you want us to pay off. Like we see you have Chase or a Cap One. great, check those, and we're going to pay them directly. So we know you are paying off your credit card debt. You're not just saying you're going to pay off your credit card debt and taking out more money. We are paying it off for you. Benefit for you is, you've consolidated everything into one bill. Other benefit is your FICO score usually goes up by 30, 35 points,
right,
because you've lowered, your utilization.
How much can you lower? Like, I got to tell you, credit card rates just blow my mind about how high they are. And I'm just curious, why are they so high? Are people so bad? Is it to cover? No, I'm curious.
Yeah, no, it's a great question.
I mean, it just seems like it's out of control. And I think it prevents people from becoming financially solvent or creating, kind of getting ahead of the game, if you will.
Yeah, there's a lot to unpack in that.
Sorry.
It is, no, it's a great question. And, there's a number of questions underneath, but I'd say the biggest thing is, if you think about how people choose credit cards, it is not based on the interest rate.
Yeah.
Right? It's my Sky Miles card or my retail store card. I'm going to get rewards for this. They don't even know what the interest rate is, or it's a promotional rate that resets. So that's one. They don't choose based on that. Half of the people don't revolve on the card. They're collecting these rewards, but they're not carrying a balance. Well, guess who's paying for that? All the people that are carrying a balance. Those people don't know what their rates are. The research we've done is half of all customers don't know the interest rate on their credit cards, and the half that say they do, more than half of them are wrong. Right?
Wow.
They think they know their rate, but they don't.
Right.
And so cards have been able, and one of the big resets with the cards was driven by the Card Act, which limited how much cards could increase rates. So they factored in higher rates.
I just want to jump in real quick. We are speaking with Scott Sanborn, CEO of LendingClub. He's been CEO for close to a decade. We're also just getting some breaking news, too, on Apple. Apple's design executive, Alan Dye, poached by Meta in a major coup. This is the most prominent design executive at Apple. This underscores a push by the social networking giant into AI-equipped consumer devices. We also have here with us Herman Chan. He's Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
Thanks. I wanted to follow up with you, Scott, on some of the medium-term expectations you laid out in Investor Day. You talked about doubling loan originations. We're talking about $18 to $20 billion a year. What are some of the levers to get you to that level? You mentioned use cases. Maybe talk about home improvement as a use case, and how do you maintain solid credit quality as you ramp up that
And
volume?
home improvement is something you're getting into, right?
That's right. Yep. So first and foremost is, as I mentioned, credit card, refining people out of their credit card debt into a fixed rate, lower rate loan is number one use case. It's about 80% of what we do. That market is the largest it's ever been. There's 1.3 trillion in credit.
80% of what you do is that. Wow.
Yeah.
Go ahead. Sorry.
So that is, 1.3 trillion in balances priced at really, really high rates. We, when the rate environment shifted and the inflationary pressure shifted, we pulled back on a lot of our marketing. So we're currently running today at sort of below our historical volumes. So we're just going back into that market. Turning back on marketing channels that we had turned off. And then the other area is, personal loans can be used literally for anything, right? And before credit cards came around and came to be, they were the dominant way consumers accessed, credit for everyday needs. So we have a major purchase finance business that's growing today, call it 50+% year on year, that's allowing things like elective medical procedures, LASIKs, braces for your kid, all kinds of procedure, fertility treatments, teeth implants. So things that insurance doesn't pay for, but you want to do and you want to do right away. Private school education, that's another one. So home improvement is sort of a next adjacency. People right now are staying in their homes longer. 75% of Americans, their mortgage rate is under 5%. They're not going anywhere.
Right.
And the homes are getting older, so the homes need to be invested in. They need to be improved. So effectively enabling home improvement through an unsecured loan, where again, we are controlling the use of proceeds. We can pay the supplier. We can pay the contractor. We've got the capability through an acquisition we announced to, disperse this in phases to multiple parties. So we're really excited to kick that off.
We've only got like 30 seconds left here. Consumer doing okay?
I'd say the consumer we serve is demonstrating themselves to be remarkably resilient. Despite,
I hear that a
you know,
lot. It's a drinking game now.
but we'll acknowledge the sentiment isn't great.